to give you a quick rundown of what you can expect. So first, Ben is going to kick us off with a little bit of an economic forecast on the case for a recession, as well as some of the counterpoints to that. We are then going to jump in. Each of the panelists is going to introduce themselves with a little background, as well as their quick economic observations of what they see coming. If anybody has questions for the panelists, you can put it right into the Q&A and we will jump in. And we have a list of some questions already that we've collected from attendees. At first is cryptocurrencies, and then it kind of shifted into stocks, macroeconomics, and he has some really great data, as well as a newsletter.
Yeah, so essentially what we want to look at are indicators that are suggesting a recession, or what are some of the counterpoints to that, and to try to be as objective as possible in that discussion. And while we are talking in this under these indicators, we are talking with reference to the United States. Just know that there are a lot of similar issues going around the world with high inflation and central banks raising interest rates. So I guess again, we are talking about the United States here, but again, you could make the same arguments for other places as well. The first thing to sort of consider when going into or thinking about us heading into a recession, it's normally caused by the central bank, like the Federal Reserve, raising interest rates too much, too quickly in a period of, say, quantitative tightening, where they are also reducing their balance sheet. And historically, it is the Federal Reserve that can send us into a recession. And so it's important to understand what are their motivations behind doing so, and what would ultimately cause them to pivot to do something else. This chart that I have up right now shows the United States interest rate, and the federal funds rate right now is at 3.25%. But what's more important is the rate at which it's going up right now. This rate that it's going up is essentially unprecedented. We have not seen a Fed move this quickly in the past, and it's putting a lot of downward pressure on the economy. Now, we need to understand why would they want to raise interest rates this quickly, and what are the indicators showing? Are we in a recession already, or are we going into one? One of the most popular indicators that I'm sure a lot of people are aware of is the often touted, well, we've had 2 consecutive quarters of negative GDP. This is often a fairly good indicator that the United States is heading into a recession. If you go back and look at prior recessions, you'll often see that we did in fact have 2 quarters of consecutive negative GDP. However, there are some other things to consider when looking at this, because it's not always just related to what is the GDP. You also have to look at other factors as well, such as the unemployment rates, and a number of other things related to to businesses in general, and are they, is the job market still relatively strong or not? One of the interesting indicators, I think, and we'll talk about this one just a brief period of time, is the yield curve. Okay, so the yield curve is a really great indicator of showing whether we are likely heading into a recession. Normally, if you are seeking yield, you would expect that the longer time frame treasury that you look at, such as the 10-year, should provide more yield on an annual basis than something shorter, such as the 2-year. However, this is not always the case. And in 2000, in preceding the recession that came in the early 2000s after the dot-com crash, preceding the recession that came in 2008 with the financial crisis, we saw the exact same phenomena occur, where you have the inversion of the yield curve, meaning you can find higher interest rates at lower time frames. So you can see the 2-year is giving you actually a higher rate than the 10-year. This is not a normal event that you see. You see this occur normally right before we go into a recession. Now, one of the things that I want to show as well is this looking at the spread between the 2-year and the 10-year, and the 3-month and the 10-year. These are what economists mainly use, some of the main ones that they use. If you look at this chart, it shows the spread between the 2-year and the 10-year. So the blue line is the spread. Whenever it goes below 0, they've inverted. And what happens after? You get a recession. The gray shaded region are indicative of prior recessions. You can see we had one in the early 80s after it inverted. We had one in the early 90s after it inverted. We had one in 2001 after it inverted in 2000. We inverted in 2006, 2007. We had the 08 recession. We even briefly inverted in mid to late 2019. And then we had a very, very brief recession in 2020 with the pandemic. But the Fed printed us out of it is how we ultimately escaped that recession. Unfortunately, they cannot do that this time. And we'll talk about that in a minute. But you can see on this chart that we have inverted once again. And it really hasn't been this bad since the 80s, when we also had a period of high inflation. One counterpoint to the idea that a recession has to occur, going back to the yield curve, is the 3-month has not yet inverted the 10-year. This is a bit of a cleaner indicator, and this is the same chart, but for the 10-year and the 3-month. When it inverts, like it did in '89, we had the 1990 recession. When it inverted in 2000, we had the 2001 recession. When it inverted in 07 and 06, we have, of course, the 2008 recession. You can see it in 2019 and 2020 as well. It has not yet inverted yet. So this would probably be one of the bigger counterpoints, although there's a good chance it will invert in the coming months. I think people should be preparing for a potential recession sometime in 2023. Now, one of the things I mentioned that happened in 2019 and 2020, there was an indication that we were going into a recession. We went into one, but then we quickly came out of it. Why did we come out of it? Because the Fed, the Federal Reserve, printed our way out of it. Now, what that ultimately did was it kicked our problems down the road by a couple of years. And now you can see this is the chart of inflation, headline inflation year over year in the United States. It has not been this high since 1981. Okay, so this is basically the highest inflation we've had in 40 years. Powell gave a speech yesterday where he acknowledged that raising interest rates this quickly will be causing pain on the public that they serve and the businesses. But he also said that what's more important, what would cause more pain, would be to go through a period of inflation becoming entrenched like it did in the 70s, and that's not what they want to see. He wants to see another period of 10, 11, 12 years economic expansion, but you simply cannot have that when inflation is at 8.3% year over year and core inflation is still going up. So these are things that we need to consider. And then the last thing I really want to touch on with regards to all of this is what would ultimately cause the Fed to pivot? What would we be looking forward to? We need to see inflation come down, but it's not coming down yet. If the unemployment rate goes up, historically, you will see the Fed pivot from a quantitative tightening cycle to a quantitative easing when unemployment starts to go up. So right now, it's still sitting at relatively low levels based on the data that they have coming in. Of course, you can look at a lot of companies are already laying people off, but as long as the unemployment rate sits this low, and as long as inflation year over year sits this high, then the Federal Reserve is likely going to continue raising interest rates into a slowing economy. We're seeing the inversion on the yield curve already for the 2-year and the 10-year. We're likely going to see it on the 3-month and the 10-year as well. And there's a good indication that, of course, because of all this, that a recession is coming. And ultimately, you could argue that the Fed is trying to get us to something like that, either a soft landing or a recession, because that will ultimately bring inflation back down. And again, they're two of their primary mandates, right, are to control inflation, get it back down to their target 2% level, but to also keep unemployment low. So hopefully that gives you a general overview of why businesses are hurting right now. It's because interest rates are going up and the Fed really is showing no signs of stopping.
So thank you, Ben, for the forecast. So for the purpose of this talk, we are going to go with Ben's strong case for a recession and assume that if we are not already in one, it is coming soon. Typically, once the news says we're in a recession, we've already been in one for a while. So that's why we're acting under these assumptions now. So I'm going to go ahead. We're going to go around and introduce all the panelists. They're going to give us a quick background as well as what they're seeing right now as their economic observations. So we're going to kick off with Wayne Brown. Tell us a little bit about yourself and what you're seeing.
Well, welcome everyone. My name is Wayne Brown. I'm the managing partner of the Walker Group. The Walker Group is a fintech boutique consulting company. So we work with fintechs. And what we do is that we work in helping fintechs to scale as well as introduce fintechs to large banks. So as we know that this is an industry that started a number of years ago, And we really see with regards to the growth of fintechs, especially not just in the US, but in global markets. So we work with fintechs in Canada, South America, and Europe. So one of the things that's interesting about this time, and Ben, thank you for a very succinct overview, is that I started the Walker Group during the recession in 2007, 2008. And so people actually thought starting a business during a recession, you must be crazy. But at that particular time, I was working for a large global bank. And in that year, they laid off 46,000 people. Now, 46,000 people into the job market that were entered throughout that in 1 year was quite significant. And so what I did is that I used that opportunity to start my own business. And I did that by working with CEOs and helping them to grow and scale their business. During a time where there was mass unemployment, there were a lot of resources or executives that were flooded into the financial services. And what would I do? But interestingly enough, with regards to the economic indicators and everything that was discussed, how that existed back in 2000 and 2008 was quite challenging. And so I realized, what is it that I wanted to do? So I produced a business plan. I thought that would be the way to make sure that I had all my ducks in a row, and found out that I executed against 5% of the business plan because the economy was in such a way that it could not be predicted with regards to everything that I thought that I would do in order to grow and scale the Walker Group. But one of the things that this particular time that I realized, and how to, in the last 15 years, to still grow and scale the Walker Group, is that when I look at the information about the economic forecast, it is true that we're seeing the fact that there are a lot of companies that are shrinking or scaling back. They're not necessarily, they're reducing their spend. And there are projects that they had in place that they had a year ago. They are moving those projects to next year or even beyond. And so when it comes to an entrepreneur that wants to grow their business, you have relationships and strong relationships in the financial sector, but they also are doubting with regards to what they need to do to reduce their expenses and how that has a rippling effect on businesses and companies. So one of the things that we can continue to focus and work with on CEOs, fintech CEOs and executives, is that we help them to see what they need to continue to focus on. And if I may share, one of the things is to not use this as an opportunity to just freeze, but to continue to reinvent themselves and grow, and therefore focus really on marketing and building their brand. And to do that in a very clear, succinct, strategic way, and to leverage a lot of the tools that are available in the media and the industry for free in order to strengthen and build their brand. And so when we're looking at what's happening in the future, that's one of the main things in which we see and which we're helping companies in order to do. The area that we are seeing a strong focus with regards to the banks as well as on fintechs is reduce, because I'm in a very specific area in the treasury management, wealth management, and consumer side of banks, is that as they are reducing their projects or reducing their spend, that ripples back to the fintechs that now have to take into consideration how they're going to differentiate what their solutions are, and so they can all stay relevant. And so we're seeing some fintechs are basically reducing their resources or their staff so that they can use the dollars in order to continue to put money and flood into their marketing and building their brand and flooding their relationships in the financial services ecosystem. I'll do a stop there so that others can introduce themselves, but I can certainly talk more about that since I live and breathe it, but I want to give everybody else a chance.
Thanks, Wayne. And we're going to get more into a lot of questions soon. Noah Rosenfarb is next. Can you give us a quick intro as well as some observations on your side?
Sure. So just a little bit about me. I'm a third generation CPA. I'm the founder of Freedom Family Office. I've been managing other people's money for 15 years, and I have a private real estate fund, private debt fund, the private equity fund, took a company public, and just about to close on my 45th real estate acquisition. So not an economist, but do this for other people. And I would say what I'm doing right now for our investment clients is that we're continuing to shift from overweight US equities to now neutral, and that may even shift to underweight US equities. We're also going to review all of our allocations to make sure that our clients are not more aggressive than they should be because of the run up in the markets that they've had in the last couple of years. We're tilting towards defensive positions like healthcare and financial services, shifting our fixed income allocation all to low duration. As Ben had mentioned early on, you're getting more yield to stay early in the curve. And then we do, as I mentioned, a little bit of private debt. We really haven't had a lot of long-term bond exposure for our investment clients for a long time. And then we're also adding more active trading of cryptos and commodities, and trying to position everyone so they have 2 to 3 years worth of cash so that they don't need to sell into a recession. I own about 6,000 apartment units, mostly in the Southeast. Cap rates have continued to compress up until maybe 6 months ago. They're really off just a little bit off that 6-month high, despite these continued rate increases. We've been selling more of our C-class assets and buying more B-class assets. The targeted returns for those asset classes have compressed as well. We're also building new B-class assets. And right now we're seeing strong headwinds on evictions and collections, especially in that Southeast market. And one of the things that historically we've bought with as high as leverage as we could buy with variable rate debt, now we're moving into more fixed rate debt to hedge our interest rate risk, or we're buying caps when we are running some interest rate exposure. When it comes to my own business, which is a family office business, helping entrepreneurs become rich beyond money, that's really our focus. And so what we're trying to do is, what can we control? Taxes being one of the main things that we can control as entrepreneurs, and figuring out how we could reduce our personal tax rates and our corporate tax rates. A lot of clients come to us when they're thinking of selling their company. And so we're trying to figure out what the plan B will look like, because many deals that people thought would be getting done either coming into the fourth quarter or potentially into next calendar year, we're trying to prepare for a plan B. But we as a business are continuing to expand. We're looking to acquire retiring financial advisors. And one of the things we've done for a decade is work with offshore talent. And I think for any US-based businesses that aren't taking advantage of the financial arbitrage with employees in lower cost jurisdictions, should definitely take a look at that. And then personally, I've been accumulating cash. So typically I only hold 0 to 5% of my allocation in cash. Right now it's at 18%. As I mentioned, kind of trading out into that low duration fixed income and private high yield debt, and then active trading of currencies and commodities and crypto, and looking for opportunities where we can create appreciation through our effort. So in real estate, we're doing that through value-added improvements in construction. In business, we're doing that through kind of that offshoring and growth strategy and acquisition strategy. And I would say the other thing that I'd add right now is to stress test your financial plan. So take a look at what it is that you are doing and see if it's going to be able to survive a couple of years of tough times.
Thank you, Noah. A lot of good stuff there. So we're going to go next to Frank Gessner.
Hey, thanks. And I'm Frank, adding here potentially a European view on the dynamics, kind of a non-US perspective, living in Germany. You member for 13 years, currently built up my 10th company, 2 IPOs in between. I was on mute. Was I would? You didn't hear me?
You're better now.
All right. Okay. So I start again. So I'm Frank, adding a European perspective here since I live in Germany. And I'm currently also in Germany. I'm EO member for 13 years, currently building up my 10th company, 2 IPOs in between. and also build up 2 venture capital funds, actively investing in technologies, currently running with Invao Group, an asset manager for crypto, for digital assets, where we manage also other people's money in financial products and manage account services with quant strategies and kind of an active trading, active management. Kind of Europe is in a especially kind of difficult situation, since the impact on the energy crisis is much larger for the major countries and industries. The dependency on Russian oil and gas and is obviously much higher. We have in most areas we have a 10x on the energy prices already, and the trend is not going down; it's kind of still going upward. And Europe is also affected by kind of, there's not really kind of an economic union of the different countries. Kind of everyone is cooking its own or is doing it its own way, and inflation rates also differ much in Europe. So going from 4% to close to 18 in other European countries. However, so the kind of the impact also comes with a weakening euro as a currency, kind of an issue you know other non-US dollar based countries really have, and this is getting worse and worse. And kind of the message that there is a recession coming is not really there yet. As you said, kind of once it's in the press, it's already too late. The indicators still show, you know, low unemployment rate, and kind of the order books are full. But if you look at the indicators below, it's really kind of is getting shocking, and wages are going to get up, and the order book's getting empty with new orders, and it's a kind of the first thing that entrepreneurs might want to do is first kind of build up an acceptance that there is a new phase coming, and we cannot continue as we did before. And what I see also in my investments in my own companies is that we definitely want to avoid the 2 extremes. Kind of one is to cut cost everywhere and shrink down everything. Kind of this might not help anyone. And the other is also not to continue with large investments. It's more on kind of looking at what processes can be more efficient. How can I produce more, or how can I do whatever I do in a more effective, more lean way, kind of optimize whatever I do. And also, this is the time to build something. I see it especially in the blockchain space, where funding has gone to whatever, a 20th or a 50th of the rates before. So most of the great software projects are much less funded than a year ago. And this is the time where great technology is being built, and where efficiency is being built, and where things are being done. On a private level, you know, similar to Noah, I also kind of try to diversify, especially into assets that are not depending on an economic development, like living or food or forest, or things that will be needed anyway, right? If the people have the budget or not, they have to live, they have to eat, they have to kind of go to renewable energy, and kind of go rather on the mega trends than on the small ones. My technology investments is currently 0. I don't believe that this is a good timing for it, and having cash is also a good thing, but not in euro. Kind of I rather have it in kind of in US-backed currencies, like in stable coins or in others, but not in a euro, which I believe will weaken more than it currently does. However, that's from my perspective. Chad, you're gone.
All right, thanks, Frank. So, you know, I've heard in a few of our speakers so far, you know, getting lean during this recession, looking to become even more optimal, and how you approach business practices. And so I am next to go over to Jerry Katz.
Hey, everybody. I'm going to set a timer for 3. I like to talk. My name is Jerry Katz. I'm the ex-president of South Florida EO. I'm an EO member for 12 years. A little background on me is I was a Wall Street trader, you know, anything from Jordan Belfort all the way to Lehman Brothers and Bear Stearns. So I'll talk a little bit about my past. When I worked on Wall Street for almost a decade, you know, we learned about cyclical markets and things of that nature. But under age 30, you know, I made a couple $1 million working on Wall Street as a broker and a trader. But I also, when the dot-com bubble came, right, I was also wiped out and I was taken down to a negative $60,000 margin call. So I experienced the effects of cycles, right? And when that happened to me, I left the business and I had a condo in Manhattan, which I sold, made a couple $100,000 and started over in real estate in South Florida. But what I understood at that point was how cyclical the economy is, right? And we talk about peaks and troughs and valleys and all that things. And you don't know what it's coming, right? And the biggest thing I'll say is we should have had, and first of all, thank you, Chad, for having this today. But, you know, the best time to have these conversations are at the peaks or on the way up, right? Not necessarily when all the news is talking about recession and everything like that, self-fulfilling, a self-fulfilling prophecy, right? So from 2000 to 2007, I accumulated around 20 to $22 million in real estate. I exited in 2007, 35 to 36 million. That put me on the map, it put me into EO and things of that nature. Looking back, I shouldn't have exited. Okay, I should have done a couple other strategies, cash out refis and things like that. But I also own many recurring revenue businesses, insurance, property casualty insurance, and things of that nature. So what I've learned in my experience today is there's always, you know, a cycle. What goes up, what comes down. But overall in history, it's always an uptrend, right? Even though we have 3 or 4 years. And trying to navigate, you know, where's the top, where's the bottom? It's very difficult. You're driving, it's like driving in the fog, right? You can only see the first 10 feet, but you got to be careful. If you make a right, you go up the mountain, or you want to go left and go up the hill. So, you know, once, you know, on Wall Street, we say, you know, buy on rumor, sell on news. Well, the news is here, right? So 12 months ago, you know, Noah's in I'm the founder of the Commercial Real Estate Forum in South Florida. 12 months ago, I was cash out refining at 3.5%, right? Getting into cash positions 12 months ago. Why? Because when our federal government prints $4 trillion, right? We know when you add money to the money supply, you're going to make people who own assets like all of us pretty wealthy pretty quick. And assets shot up 35 to 40% in the United States. And that was the time, instead of paying taxes, to go to a cash position. So that's what I did at a very low interest rate environment, right? Now, that also being said is I haven't done a real estate deal in 36 months because I'm not buying a 4 cap or a margin that's that we could turn into a negative cap at the top of a peak of maybe, you know, $4 trillion of money being printed. So today I'm in heavy cash. I'm in about 35 to 40% of my portfolio in cash. Now, when Putin invaded Ukraine, I invested heavily into tech stocks and things of that nature. Why? Because Amazon down 50% and S&P down 25 to 27% is a buying opportunity for me, right? But again, I'm not allocating all of my cash today. I'm allocating 25 to 30% of my cash into equities. I'm currently in contract and I don't syndicate, these are all my own funds and things. I'm in contract with about $4 million in real estate that, you know, 12 months ago sold for over $5 million, right? So the opportunities are here today. And that's, for me, the big point of this conversation, right? Is the time of maximum pessimism is the time to go after opportunity. The time of maximum optimism is really when we should be getting light and letting go of things. And that's my 4.5 minutes. So I could go on, but my personal opinion is when you have a $22 trillion economy in the United States and the government prints $4 trillion, right? And American saving accounts, this is the United States, are at all high levels, right? I do not, yes, by definition, we'll have a retraction, maybe to pre-COVID levels, right? Or right where the S&P was right before COVID, if you take a chart like Ben did. But I don't think I think there's too much liquidity in the system in the United States. And I think we have a retraction and there's more panic than there is reality. And now's a buying opportunity for me.
Thank you, Jerry.
Mhm.
So now we're going to go over to Ben Cowen.
I'll try to keep it shorter since I already spoke earlier. My name is Ben Cowen. I run a quantitative crypto YouTube channel, and I have a business surrounding that. We also talk about some other things like equities and the macro conditions, but the whole idea is to use quantitative analysis and some fundamental analysis to try to get some alpha on where the markets are ultimately headed over say longer periods of time, not short-term timeframes. And so essentially, you know, my outlook for 2022 at the beginning of the year, I've just started saying, you know, cash is king. You cannot really fight the Fed on this. If you think about like a swimming pool, if the Fed has pulled the drain out, they're draining liquidity out of the system right now. We can take a cup of water and throw in our own assets and hope it goes up, but the drain at the bottom is still unplugged. They're still rolling off their balance sheet. They're still raising interest rates, and I still do think cash is king under these market conditions. I'm currently, my personal conviction right now, I'm actually about 50% cash. I think I'm going to start, I think that my cash position will probably peak sometime in the next 2 months or so and start coming down quickly in 2023, because as the prior person who just spoke before me said, I mean, this is ultimately where a lot of opportunities are going to be found. Even if you go back and look at the .com bubble, we had an 85% drawdown in tech stocks, but really the opportunities that led into the next several years of expansion were the people that stuck around and bought when the times were really tough. So I'm still very cautious right now. History does show us that the stock market bottoms before the recession is over. A lot of times it can occur about 2/3 of the way into the recession. If you look at the .com crash, if you look at the financial crisis, the stock market bottomed after the Fed ended their rate cutting cycle. But this time the Fed is they're so far behind the curve, it's really hard to know what's going to happen. They should have started raising interest rates back in mid 2021 rather than waiting until 2022. So it's really hard to say what's going to happen in the short term. But look, I still think these market conditions are saying that the cash is king. Opportunities are starting to present themselves, and I think that I think a lot of really great opportunities will be here in 2023, and that a lot of generational wealth can be made from sort of sticking around through these tough times and preparing for the next, as even Powell said yesterday, the next 10, 11, 12-year economic expansion that we'll hopefully see after inflation comes back down.
Thank you, Ben. So if anybody has questions to the panel, we're going to start going through those right after I give a little background, and you can go ahead and put those in the Q&A. As you see, we have a very strong group of panelists here. So I'll give a little background on myself and some actions that I've taken based off of my observations. So my name is Chad Kalecki. I am recently have 3 companies that have all kind of approached this differently. So one of them is Liquidity Pairs Capital, which is it's a hedge fund based in cryptocurrencies, specifically decentralized finance. And we've taken the fund and put it in mostly cash because when levels were getting too high in the markets, we got a little scared about that and said this isn't sustainable. So the fund went into about 60% cash, and it's finally started buying around this time, but still in a heavy cash position. Both in the fund and in my personal portfolio, it started switching from buying more risky assets like alternative cryptocurrencies and Ethereum to just buying commodities and Bitcoin. So it's fully pivoted to what looks to be the next cycle and what's going to be strong there. I also have a software company called Cosmic Design, and so that company, what we've done is we've went with an entire virtual labor force. No more offices. Everybody's subcontractors for the most part, so it's really flexible hour setups. Basically, you work when work comes in, and it's keeping us with super controlled costs to keep us very profitable even through a recession period. And then my last company is an e-commerce company called Renugo. And so that used to be a large brick and mortar retail setup. We completely wiped that out, laid off a staff of 23, switched to pure e-commerce, really small warehouse, 4 or 5 virtual labor force that just runs the tech side of it. And then taken our inventory levels and won't keep more than 30 days of inventory at any given time now, because we do not know what's coming. If you look at the state of retail, everybody has too much inventory right now because COVID gave false information to where they thought demand was going up. So now you're going to start seeing prices in large retailers like Walmart, Target actually come down because there's so much surplus, which is odd with inflation rate going up and consumer price index. So it's an interesting environment that we're in right now. So we're gonna get into the questions right now, and I'll go ahead and kick us off. Some strategies entrepreneurs can employ to manage through a recession.
Cash is one of the questions that are popping up pretty frequently in the Q&A as well. And I think cash is really the place that you want to monitor, because that's what you're going to have as a resource if you need it, either to get you through losses that are going while you want to sustain your overhead through a down cycle so that you could come out with your team intact, or find places that you can then redeploy that capital to take advantage of assets that are on sale, which could be your competitors. So I would say manage your cash wisely is probably the best decision you could make as you head into this time frame, and hunker down a little bit, and make sure that you trim the fat if there was some, and you prepare for some rainy days that might come ahead.
To the view, if you go to cash, in addition to that, to really look at your business and to identify where those gaps are, or where there may have been some extravagant expenditures or that could need to be cut or evaluated. So a lot of times when speaking to CEOs, a lot of, especially as that business scales, sometimes it's easy to kind of get away from understanding and knowing, what those expenses look like and where they can cover and cut those back, or just look at them differently. There may be some areas that need to be reduced, and others may not need to change. But in order to pivot their strategy, I think that's a real challenge. And one of the things that I do see is that a lot of times there could be an internal stubbornness or resistance to kind of looking at their business and to streamline it or to scale it in a way that's for growth in the same time, and looking at it to see what the future can hold economically. So that's one of the things that I think is an opportunity for CEOs and entrepreneurs to take a very objective view and take the emotion out of it so they can make real sound decisions.
Around cash, so some things to throw in here. How much cash should I be holding? Anybody putting their cash into foreign currencies as opposed to the US dollar? The strength of the US dollar factor against the euro. So let's talk more on cash. How much we should be holding? Is there foreign fiat currencies that we?
If you want me to address it, I'll address it. So my cash is in cash, right? But there will be a shift, right? But the time to go to cash was for me, 9 months ago. Why? Because I have to capture inflation. If I was sitting in cash 12 months ago, right? And then we're printing money over here and assets and inflation are going up. My cash is going down between 6 and 8%, right? So I took advantage of the inflated asset prices, cashed out, and now I'm sitting in cash, right? Because assets are coming in. So technically, I should be beating the inflation rate just sitting in cash, but I'm waiting for opportunities. But, I'm trying to address the average EO member here, right? I just got my ERC credits, right? I'm sitting on another 6 figures in cash that the government just handed me, right? And when you come down to reality, I needed 3 new motors on my boat, about $120,000, right? I couldn't get them. 16 months ago, I put a deposit in for $5,000. I got a call on Monday. They're here. He's got 30 motors. He's swamped. He wasn't making the dealer, the largest Suzuki dealer in the world, by the way. He wasn't making money because he couldn't do motors. So he had to step up his business in doing services and this, but he was charging crazy prices. Now he's flooded with motors. Put him in on Monday. He wants my boat out Thursday so he can sell what he hasn't had in inventory, right? But that's going to dry up. So now I'm starting to see other mechanic shops in the boating industry, for example, they have to go back to service. They have to go back to offering, real stuff, where before they had a monopoly because whoever had a motor could charge whatever they want. So that's why I say cash is a good place to be in cash. One other thing I want to say is, like in my insurance business, right? Insurance rates are up 100%. And they're not coming down. Why? There was a couple of questions about PE money, right? When in a high interest rate environment, where do institutions put their money? Well, I'll tell you this, 10 years ago or 8 years ago, when interest rates were, 0 or whatever, institutions put it where they're looking to make 4, 5, 6, 7%. They put it in insurance pools, right? And there was so much liquidity, insurance prices dropped down. Today, the insurance market is getting more expensive and hardening, because institutions, they're not going to take risks on insurance pools when they have a T-bill at 4%, right? So it's very strange what's going on, because you still have PEs, private equity, flush with cash. I'm still flush with cash, right, because of our government, but yet the big institutions are fleeing to bonds for safety. So question for me for cash is a good place to be in cash right now, because if you're invested in assets, fine, invest a part of your cash, but if the asset price comes down, be prepared again.
I think I agree. I think cash is where you want to be, but specifically the US dollar. And I would say that about a year ago is the time to really start getting into cash. That doesn't mean you shouldn't have cash now. I think even at the depths of the recession or the depths of a bear market, cash will give you the most strength. But I do think the US dollar is the strongest right now. It's been the strongest for, basically the last year and a half. If you look at the US dollar currency index, it's just been on a bull run for, essentially for over a year now. And, perhaps next year, or maybe even in 2024 might be the time to look into other currencies. Once we go back to being risk on, you might see the euro start to show some signs of strength, but I don't think we're at the point yet where the euro is going to start showing any sustained strength against the US dollar. And the reason is, from a fundamental level, the Federal Reserve is again, they're raising interest rates. They're draining liquidity out of the system. It's going to continue to, I think, send the US dollar higher than where it currently is today. So I think the US dollar makes sense. But the final thing I'll say about this that it's somewhat concerning as well is that once the consensus view becomes that cash is where you want to be, which we're heading that direction, it normally starts to shift back the other way, and then you go back into risk assets, and that's going back to those economic cycles, that were talked about earlier. So early this year, cash wasn't really seen as where people wanted to be because they were still living off the highs of 2021 and 2020. Now we're slowly getting to the point where the consensus is that cash is king. Once everyone gets to that consensus, it's likely heading back the other direction. So that's just something to keep in mind.
So based off of that, Ben, we've had a lot of questions around if you were to start getting out of cash, where would you put it? Questions such as, are precious metals a factor, bonds, just the bank? So where do we put our cash over the next 12 months while we wait?
I jump in here. So I also agree with having cash positions, but not as a hedge. Since the cash itself is also losing purchasing power month by month, and if the numbers continue to be as high or even go up, it will be even worse. So the cash is more for me kind of an opportunity tool, to invest. When I invest, I always say, how do I see the world in 2 years, in 3 years, in 5 years, and what is appreciating in value in this period of time, and what is undervalued from this perspective now. So, for example, crypto is currently really, really down, but the likelihood that we see a 5x in crypto or a 10x in crypto in the next years, it's super, super high. I can't see this in gold, or I can't see this in other precious metals or in real estate, or also see real estate under pressure at the moment. Some investments which were super, super overvalued, like technology investments in the last years, especially in Europe, but also in the US, kind of entry prices, valuations were to the roof, and exit opportunities were more and more seldom. Now, if there is something that really you believe in, or that something really works, then cash is your tool to build up wealth for the period of time when the when everything is going well again. And also, we entrepreneurs, we always think we are our business, kind of, and we put everything in our business, especially if our business is experiencing trouble, and then we even put our own last resources into this business instead of taking hard actions. And well, if the company survives, I will be rich again, and so on. It's also, I think, a good idea to say, what is my own wealth management strategy through this recession time, and what is good for my company, and at a certain point also kind of differentiate the two different strategies. And for both, cash is king. Kind of, what can I do privately with kind of the cash I have in having unique investment opportunities, and in my companies, what can I really build up as lean processes, invest into the futures, build up new technologies, innovations in order to outperform competition tomorrow. These are two different subjects.
I've been putting some cash into, after what Frank just ran into here, is I'm still heavy in cash because there's a lot going to be opportunities further throughout this process. But I've been going into precious metal mining companies, because if we do get a rise in precious metals, as I expect we will over the next couple of years, then the mining companies will become very, very profitable, because they have already done a good job of making their operations extremely lean and being profitable when gold is at a $1,500 price point or a $1,700 price point. So if we can see a gold bull run and a silver bull run, these companies should have extremely strong profit margins. And so I felt safe starting to put some money into those over the past year. I'm not up on my positions yet, but I have a long-term view. I have, a 2 to 4 year outlook on that, and I'm still comfortable putting a little bit of my positions into that. And then I still believe in cryptocurrency, but all I'm touching is Bitcoin. But under a price of $20,000, I feel very comfortable going into something like Bitcoin, because it seems to me that if I wait 2, 3, 4 years, I should get a great return on my capital. And then in my businesses, everything is low inventory levels, low cost of operations, trying to keep increasing my cash position in the event that I get to utilize it with more opportunities. And I even went on and took on a line of credit with my businesses, even though I didn't need it, because I didn't know if that line of credit was going to be there in a few months, if the world changes a little bit more. So it made me feel more comfortable to have that cash in the bank account and pay that interest rate.
And just one comment I want to make is, I've deployed 1/3 of my cash, right? Because I look at the media, right? And when everyone's talking recession and we're having this panel, it tells me the exact same thing that happened during the .com bust, right? When I'm in a taxi in New York City and the cab drivers are flipping tech stocks called Netscape and AOL, it was the time to leave. It happened to 24 months ago in crypto, right? So the point is to me, the news is here. That's why we're having this panel, right? So I'm deploying 30% of my cash today, but I'm keeping my powder dry always for an opportunity. And keep in mind, in the background, you have, a guy in Russia named Putin, right? The last time I bought Amazon was the day that they invaded the Ukraine, and that was the bottom of the S&P so far, right? But we may dip again, right? But Amazon 50% off its highs, I like it, right? But again, it's a barbell approach. So I've deployed 1/3 of my cash today, right? Because I believe the time of maximum pessimism is right around here, or maybe last month. That's why the Fed is acting so aggressively, right? So the news is here. Buy on rumor, sell on news. That's what the institutions do. That's what smart money does.
I think the biggest unknown right now is whether inflation becomes entrenched or not. Because if it does, then you can make the argument that it'll take a little bit longer for it to see that ascent up to those levels. But I mean, the regression model for Bitcoin There's a lot of them out there. Bitcoin has been following this path for basically since it was created back in 2009. And, right now we're sort of at the lower bands of it. Okay. Like we're at the lower range of the regression bands. Out of all the indicators I'm looking at for Bitcoin, we could have another leg lower. I'm not going to lie. Like we could have another leg lower. And in fact, if history is any indication of 2014 and 2018, we will have another leg lower if history is any indication. But again, that doesn't mean, as the other panelists have said, that doesn't mean that it has to play out that way. It doesn't mean you shouldn't start accumulating now and continue to sort of wait for deals. But yeah, I mean, I think that is sort of the idea. The more pessimistic view to take, just to provide an objective view on this, is you can look at the return on Bitcoin every single cycle, and last cycle was about 20x. The cycle before that was 100x. The cycle before that was 500x. So it's been dropping by 1/5 for the last 3 cycles or so. So from a 500x, a 100x, to a 200x, or sorry, to a 20x or so, maybe a little bit above a 20x. So I mean, the more conservative viewpoint to take would be, well, what if it drops by 1/5 again? That's a 4x. I mean, a 4x from 20K gets you to 80K. Or somewhere around those levels. I mean, these are all things to consider. At the end of the day, the absolute number, I think, is kind of irrelevant. It's more so the relative move from wherever you started accumulating to wherever you start to scale out.
It reminds me of the cycles again, and I'm always driving in the fog, and I don't know. So diversification is the key of everything, right? So crypto, for me, the best thing that happened was Ethereum got centralized, right? Because it needs to be regulated, right? And if I go back to penny stocks, right, in the 90s, I go back to when the NASDAQ was born and so's. Crypto is this big compared to the world economy. You are playing in an illiquid market, right? When there's an illiquid market, you have massive volatility, massive swings. And unless you're Ben and a professional trader, then you love it, because without volatility, they can't trade. That's why they love it, right? But for somebody who's an average investor, wants to take long-term positions, try to time it, heart attacks, have margin positions, very dangerous world, right? I used to go to these Bitcoin conferences and things. They say it's going to replace the world's reserve currency. Maybe 20, 30 years from now, maybe 5 years from now. But the US dollar is still the world's reserve currency, right? And that may change. But I don't want to speculate on that with all my funds, all my cash, or take a margin position. So just be very careful in that world. It's super illiquid. And I think that Ethereum going to a centralized platform is going to create a technology of the future that is centralized. The masses and decentralization is great on paper, just like communism, right? But it doesn't work because the masses aren't sophisticated enough. That's my opinion. That's why you have government. And once the crypto and that technology moves to centralization, then you'll have real Web3 and real value. So I just want to make that comment. And again, just my opinion, diversification is the key.
Centralized finance has existed. It just became a popular topic again. From 1720 to the early 1800s, the US was decentralized. The banking system was. And 2 times it went to centralized, back to decentralized, and then centralized again, because actually the farmers needed centralization to deal properly with their crops. And the people typically say, we need centralization. We can't have 100 currencies because then we can't transact with each other. So the model has been tried, the model didn't work, and then we went back to centralization. And it was used as an interesting marketing strategy, I would say, by Vitalik with Ethereum. Got a lot of commitment, and then took it centralized. So we just watched it happen again. So in reference to something you said, Jerry, we had a question that said, what is everyone's thoughts on the status of the US dollar as the global reserve currency? And what impact does a fall have on your allocation strategies? Do we think the US dollar is coming down?
Yeah, I'm no economist, so I don't want to comment on it from that perspective, but I would definitely say that it's on the radar of the things that we talk about inside of our family office. and it influences our asset allocation. And we've been a little bit underweight on international equities and emerging market exposure, and that's one of the things that we're hoping to overweight as maybe this currency situation evolves and the US dollar loses some of its strength. We've also added cryptocurrencies to our platform, which is something new for us, new partly because of the regulation, also partly because we think it's an important asset class for our clients to have exposure to. But even you could still go to Italy and buy things, and they haven't had the global reserve currency in hundreds of years. So I think it's okay. It's not the end of the world if the US dollar is no longer the world's reserve currency. I think it'll have an impact, but I don't think it means the decimation of the American economy or the global economy by itself.
A little bit of view on that one too. So to me, on the global reserve, if the dollar falls off as the global reserve, I think what we would need to see is somebody bringing back a gold-backed currency. So that if you look at China, so China's been reducing their US dollar debt and buying more gold than they're telling us they're buying. And China historically loves gold. And so if this is a very speculative thought here, but if China were to go ahead and create a gold-backed currency, they might be able to gain the control and then move through the general cycle of gold-backed currency straight back to fiat and then be the reserve. So to me, it just paints more of a case for gold going into a bull run over the next few years. Because if the global powers believe the US is weak and that the currency can be taken off, they will go for it. And they will do what it takes to take it off. Is dollar cost averaging a smart strategy for securities investing during a period like this? What about crypto? And it also relates to another question around what can we expect when our emotions are going rampant with, like, is it the bottom? Is it the top? How do I invest? So let's get into those topics.
All of that to me goes back to your financial plan. So dollar cost averaging could be a great strategy as long as you're maintaining enough cash to satisfy what could be your needs in an economic downturn. On the flip side, having whether it's stock market exposure, crypto exposure, I think all of that needs to tie to a financial plan. And most of the entrepreneurs that I speak with around their personal finances, they don't have a financial plan. They have kind of their own concept of how they want to manage their finances, but it's not really a comprehensive, cohesive plan that takes into account their taxes, their cash flow, their generation of income, and putting all that together on paper to have something that's well thought out. So to me, as I kind of led off in the comments, I would say that to me is the starting point, is to create a financial plan, know where you are, know where you want to be, and have a plan for how you're going to get there.
Get some hands on cash now. The rates are higher right now. What are our best means to go ahead and acquire more cash to have a strength in that position?
It all depends what the business is. And if you have assets with a lot of equity that have been run up because, 35% increase in assets in 24 months, go to the bank. I see a little couple comments here about liquidity and loans, right? I mean, the time to lock in interest rates and loans was, a year ago, right? But listen, we're still historically low, right? My next real estate deal, my loans at 5.25. The banks are flexible. By the way, they're going to give me 2 years interest only. And when I do the math, even at the third year, I'm at 11% cash on cash return on a real estate deal because the prices are coming to me, right? They're finally here. But how do you get cash? I typically get cash from assets that have appreciated over time, right? Instead of selling and paying capital gains, I cash out refi with the bank, right? Rich dad, poor dad. We don't work for money. Money works for us. So you need cash, right? And the bank is your best friend for cash, right? It gives you leverage. Syndicating with investors, these are the times that you can raise the cash for your plan to execute in what I call the time of maximum pessimism. So you either have to raise assets or listen, the government's still feeding me money, right? there's still programs available. I'm getting like the ERC credit. If you haven't got it, get it. I mean, I just got infused with 6 figures again from the government. One other thing I want to mention though, in the US and like China, I also like the demographics, right? Here in the US, we have the largest workforce that we've ever had, right? That is now the millennials, right? There's about 300, don't quote me, but 330 to 340 million people in the United States. The largest generation before that was the baby boomers, about 80 million people. They created our economy here, the stock market, entrepreneurship, everything, right? They were the hippies and then they turned entrepreneurs and Republicans. Today you have the millennials. There's 120 million of them. And over the last 3 to 4 years, they have entered the workforce. That's why we have 20 million housing units short in the United States. So now you have the largest workforce entering the economy over the last 36, 4, 5 years, right? It creates production. I'm betting on the USA. China's in a recession. They had their one baby policy, right? They eliminated their low-cost, cheap labor workforce. Their workforce is over. India will be the next superpower. So demographics play a lot of role. Yes, I focus on the macro, but the micro to me is more important, right? I'm based in 4 or 5 states in my business, South Florida. I know what's going on in my backyard more than anything, right? So for me, that's the most important. I follow demographics, people, spending habits, savings rates, things like that. So just wanted to throw that out there.
Question, it really depends, as Jerry said, and what type of business you're in, but kind of to discuss in your team, what opportunities are there, right? So maybe you say, well, a year ago we said no to this kind of new equity round we wanted to raise. Now, knowing that cash might be king, right? Let's be open to this. Or if there is a opportunity to get whatever third-party credit systems or whatever, right? Kind of, it brings you through it can bring you through a hard time. So it becomes more attractive than it potentially was a year ago. Be open for whatever, or opportunities to sell assets that have appreciated already much above the purchasing price. Kind of, if in 1 year time the situation might be much worse if you need the cash then. Now it's kind of potentially the last quarter before recession where you can execute some transactions. Afterwards, kind of raising new capital, getting loans, selling assets might get much more difficult.
That it's always got to figure out how to generate cash, but the one thing you don't want to do is you don't want to be the investor that sort of pukes out the lows on the stock market under some type of capitulation event. So that's not the way to generate cash, right? It's not to sell your assets when they're 50% down or 70% down. The time to do that was, of course, a year ago. If you missed it, it's a learning opportunity. You'll try to figure that out for next time. But what you don't want to do is you don't want to be that last person in the cycle that sort of creates the bottom that then we bounce off of and go into our next area of economic expansion. So I would be careful, I'd be careful offloading, say, a lot of risk assets late into the downturn.
Have we not seen a bump yet in Ethereum after the merge? Is this largely tied to the Bitcoin price, and also what's going on with the US dollar in association to this?
Talk about this, I think. So, I mean, there's a fundamental perspective, there's the technical perspective. From the technical perspective, it makes complete sense that the Ether Bitcoin valuation needs to come down a lot over the next several months. We're playing the same cycle. It's playing out the exact same way that it did in 2018. Bitcoin's dominance bottomed at 40% during mid-2018, where Ethereum dominance topped at around 20 to 21%. We just saw the same exact thing happen this time. Bitcoin dominance bottomed at 39 to 40%. We rallied into the Ether merge and the Ethereum dominance went back up to 20 to 21%. And everyone shouts this time is different. And this is going to change everything. But look, it doesn't matter. The fundamentals don't matter in a bear market. It does not matter if liquidity is not there. Crypto only does very, very well under perfect market conditions. And perfect market conditions are, for instance, when the Federal Reserve prints $4 trillion. We need access to cheap liquidity for these very high risk assets to do well. I'm very bullish on Ethereum. I think it's going to do incredibly well in the next area of economic expansion. But in the short term, markets do not like uncertainty. And they especially do not like uncertainty when we're talking about a recession, and a transition from proof of work to proof of stake during a bear market is only going to lead to uncertainty as to exactly what that's going to look like. There are a lot of software upgrades as well. We don't know, we don't know exactly how things are going to play out here over the next few months. So I think it's a sort of like a buy the rumor, sell the news, unfortunately, which is unfortunately what it ends up usually being. And I would say I'm expecting further downside on the Ether Bitcoin pair. I do think Bitcoin will outperform Ethereum over the next like 6 to 12 months. But once we get beyond that and we get out into say 2024, 2025, I think you're going to see Ethereum come roaring back as we really start to figure out what are its use cases and how will it, be the what came out of the dot-com bubble. I mean, remember, think back to the dot-com bubble and all the companies that were just useless zombie companies that collapsed the minute we went into a recession, and look at everything that came out of it. Right? We're seeing that same thing play out right now with crypto. And honestly, the price chart for crypto looks almost identical to what happened with the dot-com asset class back in 2000. They both peaked at approximately 3 trillion in their overall market capitalization. And if they need to go down 85%, if crypto needs to go down 85% like the dot-com bubble did, then we could still see crypto come down even further. So I think you're going to see some short-term depreciation on the Ether Bitcoin pair, but I think it's going to explode after we get through this recessionary time and as we get into the next period of economic expansion.
Comments, right? Remember the tech bubble, right? At .com, it made me rich and then wiped me out. That was 22 to 25 years ago, and now we have mature technology, right? The crypto bubble just popped, right? So most of the companies that I was trading don't exist. Even AOL doesn't exist. Right? Netscape, all of those. Webvan was today's Grubhub. It went to $180 a share. It's gone, right? And I can show you the same thing in junk bonds under Michael Milken, and we did the same thing in biotechs, right? I took Boston Scientific public. We took 140 biotechs public on Wall Street. One is standing today, Boston Scientific. So they're creating a new industry, and it is the future. But you're in super early. Remember that.
It's also important to remember in crypto, every 3 or 4 years, the top 10 is constantly changing, with essentially the except for like say Bitcoin and Ethereum, the other ones come and go multiple times. I mean, in 2013, I remember you could go out and buy BBQ coin, right? 2013 was a simpler time for crypto. So yeah, remember in crypto, your blue chips are Bitcoin and ETH, and the other ones can easily come and go.
Crypto to real estate. We have a few questions around that. So for the guys here that are real estate investors, where do you see the market going in the next 12 months? How are you preparing currently? Florida versus New York versus California? And a couple of people have said they're looking to purchase homes and they're trying to figure this out.
So I love the mantra, I don't wait to buy real estate, I buy real estate and wait. And so I kind of live by that ethos, going back to that dollar cost averaging question, I'm always dollar cost averaging into real estate. I would say this calendar year, I'll have more dispositions than acquisitions. So that might be insightful. I'm a net seller this year of real estate. I was probably about neutral last year. Maybe I was acquiring more than I was selling last year, and basically every year before that I was acquiring more than I was selling throughout the whole cycle. I believe the residential real estate market is totally different than the commercial real estate market, and so it's hard to get residential real estate advice from commercial real estate investors because we see things very differently. So I would speak with the local brokers in your local market to talk to them about the supply side and the demand side in your local market, because even one small neighborhood within your region that you're looking to buy in could be very strong when, just across the street, it could be very weak. Whereas I think commercial real estate is more often based on, financial modeling and not necessarily school districts or where people want to live. Maybe a couple other things on real estate, and time to buy is around financing real estate and appreciation. So as Jerry alluded to, we're going to buy a 278 unit apartment complex in Homewood, Alabama next month. I think our loan on that, which will have a variable rate for the 9 or so months that we plan to hold it, we'll be able to cap that at a top of around 7.25% for what we think will be no longer than a 1-year hold period. And then as we refinance, we're kind of budgeting to refinance into a 5.5% loan. But that 5.5% over 30 years, if we continue to have high rates of inflation, then obviously the paying that money further in the future can actually be a net positive for us if inflation's over that interest rate in the long run. And I think that's an important thing for you to remember when you buy real estate with fixed rate debt, is you just got to look at what is the cost of that debt in comparison to the inflation rate to figure out if there's positive leverage going in your direction or not.
Around the euro so far. So how will the strength of the US dollar factor into the European economy? Because the dollar is strong against the euro, is there some opportunity there, possibly buying real estate next spring in Europe to maximize on the return as the euro recovers in time? Are there any other avenues to take advantage of that? Anybody have any comments on that?
Living in Europe, the kind of the weakness of the euro is rather kind of the risk the market is seeing on the European economy, given the kind of the current circumstances with the Ukraine-Russian war and energy crisis, and the impact and the dependency on Germany. Kind of Germany is kind of the strongest economy in Europe, and Germany depends a lot on China, and kind of the outlook for China is negative. So therefore, kind of the euro itself as a currency is currently considered as weak, and I even expect that the US dollar euro pair will even go more to the favorite of the US dollar than to the euro in the next 1 year or 2 years. If this war is not if this war is continuing, and the politics does not find any way to find solutions for the energy crisis, for the economy here. If I would be an alien and I would look at this planet and say, well, I would like to do some asset allocation, and I look at the different regions, kind of Asia, US, and Europe, and I would be totally neutral, since I'm an alien, I don't have any stake, I don't have any family anywhere. I would potentially not put my money on Europe if I would do my homework, right? Kind of, I would not put it on Europe. I would rather put it into kind of some emerging Asian countries, kind of the US things, kind of as the world economy is also moving and changing. Europe is currently not in the very best position, right? The numbers, kind of real estate still a little bit. I also run a real estate company, kind of we do project development, not investment, kind of we buy and develop real estate. Not only that asset price or real estate prices are still super high due to kind of the money printing result that asset prices raise up. Also, cost of building is super high. This is to be expected to change dramatically in the next 6 months. That capacity at kind of real estate service companies, kind of for building and whatever, they're kind of, you will see a lot of capacity and price competition again, and which we don't see at the moment. At the moment, the order books are totally full, but in 1 year time, this will dramatically change.
What industries do you see really capitalizing on the upcoming and current recessionary climate? So here we saw everyone go back to school in 2008, which increased the education market massively. What industry do you see doing the same?
Infrastructure, I think, is a place where we're anticipating a lot of investment out of the government programs that have already been approved. And then, during a recessionary environment, the probability that there'd be more stimulus type packages related to infrastructure, I think, could be a good place to continue to invest in our economy.
I have one as well. So before my current ventures, I was in liquidation, inventory, and returns processing for retail. Junk businesses generally do well in recessions. So discount and deals type retail, I don't think physical retail anymore. especially after the changes in COVID. But if discount e-commerce, if there's some good companies that can be found in those industries, I can see those doing well. That's just one of them. Possibly even storage units, people getting evicted and out of their homes and having to use storage. And in that industry, generally it becomes a recurring charge on your monthly bill, and people have issues with parting ways with their junk. So they will pay that consistently.
One of my definitions is an an entrepreneur is, what are we? We study markets, right? And whether it's, Chad's business, whether it's real estate, whether it's online sales, we study markets. So local, or your business, right? We study. And when you study the market, you know the prices, you know what's value and what's not. And then when all of a sudden there's an opportunity, it's right in front of your face. It's arbitrage, right? So I do it every morning. I have a morning routine, right? I spend an hour in the morning looking for real estate. I have, various sources. I know my markets. I know my local markets. When they pop out, you see them. I buy cars, right? I love cars. I bought my last car in Texas. Why? I live in Miami. Why? Because I know the markets. And when I see the market offer an opportunity, there's a play. And that's your opportunity. And when you know it that well, that's what we do. And I can go into every business. I bought 2 insurance agencies in the middle of COVID, which traded 10 to 12 times EBITDA, but there was a panic because people were moving to North Carolina. COVID's never going to open. Bought 2 insurance agencies. Why? Because I'm constantly studying my market. So whatever your business is, whether it's your vendors, your suppliers, you need a warehouse, know your market. As entrepreneurs, we look for the arbitrage plays. We look for the inefficiencies in a business model and everything like that. And then we see the opportunity. The worst thing that, in my experience, where I should have made a lot more, is I got stuck in the mud overanalyzing the economy, right? Or where are we going? Or where are interest rates going? And things of that nature. You're never going to know. I mentioned that you're driving in the fog. But if you know your game, or you know your market, and you study it constantly, right? Luck is seeing that. It pops up, right? My son and I were in the car. My dad, he said, well, there's a very busy corner where I live. He goes, Dad, look, it's vacant. I go, what? He goes, where that store was, the GNC. He goes, that's a great place for a pizza place. Why? Because of the traffic. Even my son, he can see the opportunity because he studies the market, because he's opening pizza places, understands the rent. So who do we rely on? Understanding your market, understanding the values, and you'll see the arbitrage, right? And diversification or risk strategy.
Also, I think the question was rather, what is short term within the recession? What are kind of opportunities there? What business, is food delivery becoming more attractive since people do not have the cash anymore to go to restaurants? Kind of use this kind of type of rationals, which is always kind of a little bit speculative and difficult. An alternative thinking to this is to imagine the world. How will it be when the crisis is over? How will the world have changed? Kind of, will there be, what is with renewable energy? What is with water? What is with kind of seeing more kind of the long-term mega trends, the big ones? What's with artificial intelligence? What is with crypto or other things? And look, in the crisis, do I have good buying opportunities since prices are super low for what I envision in 3 years? Kind of not to bet on something within the crisis, but to look for opportunities to buy something that will appreciate after the crisis. This is kind of an alternative thinking to this.
Absolutely great panel. I hope everybody has enjoyed. I say we finish it off with just some closing thoughts from each of us. And for all the attendees, please feel free to drop away some takeaways in the chat before the session ends. So let's go in we can go in the reverse order as we started. So Ben, you want to kick us off with the closing thoughts?
Sure. I'll probably close by saying, like, there's still a lot of indicators that suggest a recession is coming. Once the news picks it up, it's, I mean, it'll have been obvious to anyone who was looking well in advance of whenever you really start to see it go mainstream. But I think there's a lot of, despite how difficult these times are and how difficult next year could be, I think in terms of investments, there are going to be generational wealth building opportunities over the next 12 to 18 months. And I think that the people who are patient and they don't just jump all in all at once, they'll be the ones that will benefit the most. Because I mean, at the end of the day, I will not bet against the United States in the long term. I mean, you know, could we have a recession? Could we have a period where we, you know, see negative growth for a few quarters? Yes, we could, but I do think the United States will come booming back, and hopefully other the world economy as well. But I'm not going to bet against it in the long term. And so I think the next 12 to 18 months, a lot of great opportunities, and just make sure they don't pass you by.
Closing comments. I mean, you've heard my comments. I would say opportunity, right? Opportunity, and we wait for these moments. We wait for these moments. This is the time, right? And it's over the next 12 months, the next 24 months, but the time is now. So I would just say opportunity and diversification. No one knows the top, no one knows the bottom, but the trend is your friend, right? And in the words of Sir Isaac Templeton, right? The time of maximum pessimism is the time of opportunity. The time of maximum optimism is the time to sell it. Take your profits.
Frank, you want to go ahead and share your closing thoughts?
Yeah, I also go with Jerry, kind of see it as an opportunity first for your business to make decisions that were not possible before. So maybe you want to get rid of something that's, you know, it's not going on anyway. And this is the opportunity also to make really to really think what is the core of your company and how can I deliver this in a more efficient and more productive and a leaner and whatever way. This is the time to get this resolved. And what should I invest in what area should we continue to invest, since this will be our competitive advantage when the market turns around again. Privately, also see it as an opportunity. This is where wealth is being built up or massively expanded, since you see there are opportunities on your way. So the mindset, the mood shall not be fear or, oh, there's a crisis and what should I do? So, oh, this is interesting. The world is changing. We are entrepreneurs. We can catch on this and we can profit on this and we can benefit from it. And this, I think, opens up and gives you the next phase.
One thing we didn't talk about is education. And I think each of us as entrepreneurs, the best investments we can make are in ourselves and in learning and in understanding how we can find and capture and exploit opportunities. And so as we go into what might be tough times for many people, one of the advantages of our ability as entrepreneurs is to capture value and find that arbitrage that Jerry was talking about. And if you don't feel like you're in a good position to do that today, thinking through how can you get yourself in a better position through education, training, mentorship, masterminds, whatever it may be, adopt an attitude of gratitude around this, what's coming. Most of us on the panel have so far expressed our somewhat excitement around the opportunity that's coming ahead of us. And that's not to discount the impact that it may have on tens of millions or hundreds of millions of people, or even billions of people around the world. But we're a unique breed as entrepreneurs. And so these are the times where we can really grow personally, professionally, and within our communities to become even better leaders, better managers, and create that wealth that maybe, if that's a goal of yours, now's a good time to stay focused on it.
Guys on here have subscriptions for free newsletters. I'm a subscriber to a few of the people here, and it's great content, so make sure to check them out. And thank you for coming and attending today. So Wayne, do you want to go ahead and close us off with your thoughts?
Sure. I know I'll just be real brief. And I think the comments and the closing comments were spot on. I think since I'm involved in technology, obviously this is an area that's so sensitive to what's going on and has decreased valuation. But I tell anyone to really not only just focus inwardly on your company, but also look outside. Look outside, avail yourself to events like this, avail yourself to industry analysts, avail yourself to information and data that's outside of your company or even your industry, because that's going to help so that you can know what's the future look like. That's going to have an impact on what your businesses are eventually going to be. And one point is that, and I mentioned it also, that it's even though this could be a very emotional time for the CEO, it still has to be very objective, very factual. That's going to help, because emotion, although could drive decisions, but may not always be the best choice.
For attending today, I want to thank this great group of panelists for coming on, make the time to speak with us. It's been super insightful. I know I learned a lot. I hope everybody else did as well. And I look forward to next month. I believe I'm going to have Ben on in October, and we're going to do some more of an in-depth analysis on technicals around cryptocurrencies, around stocks, around macroeconomics. And so if you're looking for the fine detail, you can check us out next month.